The last in, first out, LIFO inventory costing method assumes that the last units purchased are the first units sold. A way to visualize this is to think of a box of pumpkins or watermelons. Sometimes in a market, you will see a box of these large fruits being displayed as pictured. The first watermelons or pumpkins that were loaded into the bin are at the bottom, and the last watermelons or pumpkins that were loaded into the bin are at the top. So when a customer comes by to buy a watermelon or a pumpkin, they will choose the one from the top because it is easiest to get to. Therefore, the last in the bin is the first one sold. Last in, first out. Again, remember this is just a visualization. This does not have to be how inventory is actually flowing through our business. We just need to choose a method and be consistent. Let's do an example using the last in, first out inventory costing method. Here we have Laker Company. They have transactions in January. At January 1st, they had beginning inventory of $840. On January 10th, they had a sale. January 20th, a purchase. January 25th, another sale. And January 30th, another purchase. We will use a chart to keep a nice, neat record of our inventory cost flow. I have already loaded our beginning inventory in here. January 1st, we have a quantity of 140 units, costing $6 per unit. Our inventory total cost is $840 at the beginning of the year. On January 10th, we have a sale. 100 units were sold for a price of $15 per unit. This $15 per unit is the price that the customer paid. We need to figure out what the merchandiser's cost was for those units. The only units on hand at January 10th to be sold are the beginning inventory units, so the cost of those units are $6 per unit. We sold 100 of the $6 per unit inventory items. We will log this in the cost of goods sold columns. 100 units at $6 per unit is a total cost of $600 for cost of goods sold for this transaction. How much do we have left after this sale? Well, we had 140 units. We sold 100, so we only have 40 left. They are the $6 units. Our ending inventory cost is 40 units times $6 per unit, $240. We need to make the journal entry for the sale. On January 10th, we sold 100 units at a price of $15 per unit. We can assume this is a cash sale. We're going to debit cash. $15 per unit times 100 units is $1,500. And credit sales revenue, $1,500. Whenever we have a sale, we have to make two journal entries, one to record the revenue and one to record the cost of goods sold. We debit cost of goods sold. Credit merchandise inventory. We are removing these units from our merchandise inventory account because they have been sold. The cost of those units were $6 per unit. $6 per unit times 100 units is $600. On January 20th, we made a purchase. We purchased 60 units at a cost of $5 per unit. We will log this on our chart. On January 20th, we purchased 60 units at a cost of $5 per unit. So the total cost of that purchase was $300. We need to recalculate ending inventory. We have 40 of the original $6 units left, and now we have 60 $5 units. So altogether, our ending inventory after January 20th transaction is $540. The journal entry for this transaction on January 20th is a debit to merchandise inventory, the increase in our inventory account with the new purchase. We can assume that we paid cash for this purchase, $300. On January 25th, there was a sale. We sold 80 units at a price of $15 per unit to our customers. But which 80 units were these? Were these the units from beginning inventory? Were these the ones that we just purchased? How much of each? We use our inventory costing method, last in, first out, to determine that. We sold 80 units. Since we are using last in, first out, we are going to sell those $65 per unit most recently purchased units first. The 60 units that we just purchased for $5 per unit will be sold first, and then we will move to the next most recent purchase for the remaining 20 of the total 80 units that were sold. So 20 of the $6 units. Our total cost of goods sold for the January 25th sale is $420. What do we have left? Well, we still have 20 of those original $6 units from beginning inventory. Ending inventory is $120. We need to record the journal entries for this sale. The sale was made on January 25th. We debit cash for the cash received for the sale and credit sales revenue. The units were sold for a price of $15 per unit. There were 80 units sold. $1,200. And then we record the entry for cost of goods sold. Debit cost of goods sold. Credit merchandise inventory. In the amount of $420 that we calculated as cost of goods sold using our LIFO chart. Our last transaction occurred on January 30th. We made a purchase of 180 units at a price of $4.50 per unit. We will log the purchase on our LIFO chart. 180 units. The price was $4.50 per unit. Total cost of the purchase was $810. Now we can calculate our new balance and ending inventory. We have 20 of the original $6 units and 180 of the newly purchased $4.50 units. Ending inventory balance is calculated the 20 units times the $6 per unit plus the 180 units times the $4.50 per unit. Ending inventory balance is $930. Total cost of goods sold is $420, and total purchases is $1,110. We need to record the journal entry for that final purchase on January 30th. Debit merchandise inventory. Credit cash for the amount of the purchase, $810. My favorite part is proving the balances, so let's do that. Let's use our cost of goods sold calculation to prove our cost of goods sold balance. Beginning inventory was $840. We can get this at the top of our chart. Our purchases for the period were $1,110. This is at the bottom of the purchases column of our chart. So our cost of goods available for sale, $840 plus $1,110 is $1,950. We can subtract our ending inventory from the bottom of our chart, $930, and we should be able to calculate cost of goods sold of $1,020. And yes, that matches cost of goods sold on the bottom of our chart. Now let's prove our ending inventory balance. We started with beginning inventory of $840. And we had a sale on January 10th for a cost of $600. On January 20th, there was a purchase of $300. On January 25th, a sale of $420. On January 30th, a purchase of $810. Our debits minus our credits equals $930, which matches ending inventory from our chart.